Hello, everyone, and thank you for joining us for this month's KJH Insights podcast. I'm Sarah Bull, Senior Portfolio Manager at KJH Investors. As always, our goal with this podcast is to help clients make sense of the market environment and understand how we are thinking and protecting their capital through changing cycles. I'd like to welcome Andrew Csumrik back to the podcast today. Andrew is a Senior Portfolio Manager and a key member of the KJH investment team. Andrew, great to see you again.
Yeah, thanks for having me, Sarah.
Yeah, I was off last week and Joel subbed in, but it's nice to be back.
Yeah.
So, Andrew, last week we had our mid-year client event. It was nice to connect with clients and get a chance to get caught up. And you and Peter Barlis and Reza Samahand really talked about where we've been in the past 6 months, and equity markets have posted solid gains. But I think really what you said was that doesn't tell the whole story of what has happened between January and today. The market has had a lot of volatility associated with geopolitical conflicts, inflation concerns, and then obviously repricing in software and AI-sensitive tech stocks. So what I was hoping we could do today is revisit some of the themes that we discussed at our mid-year and look back on the past 6 months and do a look forward in terms of where we think the market may be going into the back end of the year. So why don't I hand it over to you?
Yeah, perfect. I think you put it out pretty well there. If you just take any index, we're kind of calling it right now, the market's probably up around high single digits. You can obviously look at the S&P 500, you can look at the TSX, there's NASDAQ, there's different indices, but that'd probably be the average stock up around high single digits. And when you think halfway through the years, that's pretty good returns. But you're right, what we've really had to go through in the first half of 2026, we kind of said there was 4 different things that happened. You talked about at the beginning, we had the software, it's called SaaScopalyse is what some people have been terming it, because SaaS, SaaS is software as a service. A lot of those software companies were hit really hard. People started questioning whether AI is going to kill their business model. And so it was pretty bad if you just think of some of these companies, Workday, Snowflake, HubSpot, just to name a few, down 50 to 80% from their peaks. And these were some of the best performing stocks of the last decade plus, because they were software businesses, limited capital expenditures, great returns, great incremental margins. But really, Anthropic coming out and their AI being Claude, some of the models there really were able to do things that were a lot faster than I think anybody had expected. And you started questioning whether you really needed these software companies when it was so easy to code, so easy to make these businesses. And so not only software, it hit a lot of different industries. We were up saying it was hitting logistics companies, it was hitting legal businesses, it was hitting consulting. And so it really seemed to go through different industries where people were concerned to say, can these faster developments in AI hit different parts of the market? And so over that time period, the overall market was doing okay, but under the surface, some of the best performing stocks of the last decade were really getting hit hard, and probably for reasonable reasons. We didn't step in either in that time frame when we spoke, probably in podcast past, because there's real issues to the moats that these businesses have. Can they keep pushing price? Can they keep, the number of seats that they have growing? And so that was kind of the January effect, I would say. And then obviously we moved into February into March, and everything kind of got taken over by the U.S. and Israel attacks on Iran and closing the Strait of Hormuz. We don't need to go over it too much, but that sent oil price spiking. We had Brent go from $70 up to over 125 at one point. And so that really saw the first bout of real volatility where the S&P 500 fell close to 10% over that time frame. And with that oil shock kind of came another inflation scare, which I would say we spoke a lot about in 2022, the post-COVID environment. And I think most thought that was kind of behind us. We'd been tracking, any CPI measure that you look at back into the 2 to 3% range, which is more of where the Fed likes it, and I think is the reasonable environment for everybody. But then with oil rising as quick as it did, inflation started coming back up. That put kind of the Fed on hold. People started talking about the Fed having to raise rates. And so I think that was also a big issue that the market had to contend with. We entered the year assuming interest rates were going to be cut. We had a new chairman of the Fed come in. We all know that President Trump wants rates lower, but when with oil spiking like it is, it was going to run through the whole economy and no longer was it going to be lower interest rates. So there was a fair amount to contend with, even though, we sat and looked back and equity markets were doing relatively well here halfway through the year.
Help us understand why they were doing well. A lot of people have said the market was really getting driven by the Magnificent Seven. And, I think what you and the team pointed out is really year to date, most importantly, is the gains in the market have largely been supported by fundamentals, not speculation. Can you unpack that for us?
Yeah, I think there's a few reasons that we believe the market continued to do well, even though you had, a lot going on behind the scenes. So you did have it sell off immediately, but it recovered very quickly. And I'd say that the main one being on the geopolitical piece, the market kind of looked at it as to say, there's obviously so many moving pieces on what a ceasefire looked like. What are they doing? And the market basically took the stance of there's no reason for this to continue over a long period of time. I know it seemed like there may not have been an end in sight. Is the end the proper one? Are we getting the solution that everyone wanted? But really, I think it was pretty clear if you didn't and you continued to keep the strait closed, taking 20% of oil production off the market would have been a huge energy crisis for the world and probably been a global recession. So it was one of those where it seemed self-inflicted where you could change it at a point in time. And the market kind of said, probably cooler heads are going to prevail at some point. So I think that's why you didn't see more of there was that draconian scenario out there, but I think the market really said it was such a low probability. So that was one. The other one being I talked about AI hitting software companies, but the acceleration of AI actually helped a ton of companies that are tied to artificial intelligence just because you had the uptake really take off, the use cases of it, companies spending a lot of money on it, man, you were starting to see returns. So before it was all just CapEx, endless CapEx, and people said, where's all this money going? And then you started to see companies like Anthropic going from 1 billion annualized revenue only 8 months ago. And then they started showing that it was going to be close to 50 billion run rate. Like that's an incredible growth rate. And so AI really did help the market again. There's a lot of companies that were generating real revenue. There's supply shortages everywhere. If you look at memory like Micron, the earnings growth was incredible there. And then I think just the US economy stayed very resilient during all of this. You've got the labor market. We had unemployment claims hit record lows. And so even though there's a lot of noise, the US economy still the most important in the world. It held up well. And then I've left the most important to the end is just this earnings story. Q1 earnings, we saw over 20% EPS growth in the market. Expectations have risen way up. So even during all the volatility, earnings expectations continue to rise during the entire first half of 2026. And we always say markets are driven by earnings. There's a lot of headlines, there's a lot of volatility, but the underlying earnings is what drives everything. And so I left it till the end, but if you were to ask me, why is the market doing so well? I'd say it's earnings. We even look at it because people say, how's it doing well? We're overvalued. And actually today, because earnings have grown faster than the market has, we're up 8 to 9%, but earnings are up 20% plus. We've actually seen multiple contractions. So the market's actually cheaper today than it was at the beginning of the year or even middle of last year, just because earnings have exceeded that of the market growth. So I think that's really the main driver.
And you've seen those earnings across large cap, mid cap, and small cap, correct?
Yeah, and I think that's an important differentiation from call it the last 2 or 3 years. The market was seeing earnings growth, but it really was tied to the very mega cap, not even large cap, but mega cap companies were driving most of the earnings growth, which they're part of the market, so it all counts. But we really weren't seeing it in call it the main street businesses. You weren't seeing that, whereas we are starting to see that now. So I think that's an important differentiation from the last few years.
And are you seeing a change in market leadership in terms of the overall investment landscape and who the leaders are, how that's changing in the past decade?
Yeah, I think I'll take the question two ways. Immediately right now, the Magnificent Seven were clearly the leaders of probably the last 5, 6 years, but even more so in the last 2 or 3. They've actually been massive underperformers this year. A lot of it being they're the ones spending a ton of money. So you're seeing their free cash flow start to come down as they're spending more. And I think we were seeing a big broadening out earlier this year in January. We'd been talking about it a lot kind of in the latter part of last year. We expected a broadening of the market. And I would say that got put on pause when the war in Iran came. You saw oil spike, interest rates go higher. People were unsure of the global economy because really for a broadening, you need good economic growth, you need lower interest rates. And so I think you saw a pause there, but the ingredients are there for that to continue going forward. The Magnificent Seven, though, I do still think they're still great businesses. Their valuations are now cheaper. It might take a little while for investors to go back to them, but I still think there's probably a case to be made there. But over the next 2 to 3 years, they'll probably do okay. But when you ask about longer term and kind of the decade or so, we've been starting to talk more and more about, I don't know what the word is, but regime change really. And basically since post-financial crisis up until COVID or the inflation shock of 2022, we had the zero interest rate environment. We had no inflation. We couldn't generate inflation. We were trying and trying. They were doing quantitative easing, QE 1, 2, 3, 4. We were trying to do everything to get inflation back into the economy and it couldn't. And it was just a really different environment. Whereas I think now going forward, we had the inflation shock, that's top of mind. And then you just have everything that's going on, whether it be geopolitical events around the world, kind of moving from just in time inventory, be as efficient as you can, globalization, to really that's broken down over the last few years. And now the more the focus is on security of supply as opposed to efficiency. And so all of those things combined, I think we've really been saying that the next decade is going to look a lot different than the previous decade. And we're looking at that, whether it's hard assets, industrial reshoring, the critical minerals, energy infrastructure. And I didn't touch on defense. Defense spending is going to be much different. The US has basically been saying their protection isn't free anymore. So a lot of these NATO countries have to step up their spending, and we're seeing it happening. And so when you say market leadership in the short term, there's a broadening theme that I think will continue to play out on the Magnificent Seven taking a break here. But a longer term perspective, I think is even more important when you are investing in the long term. I think investors need to be able to adapt to the new regime.
Yeah, I think that was a great way to answer that question because you're absolutely right. I mean, on the AI area, you now have space and robotics emerging as secular growth areas for AI. But then, as you said, there's been a lot of change in terms of market leadership beyond that. So, how does Canada fit into everything you just said?
Yeah, I think Canada is a very interesting one. And from last week, I got up and I was talking, and my main theme was that Canada is becoming investable again. And it really is because of this regime change is providing a big opportunity, but it's also up to Canada to take that opportunity. So if you take a step back in my 15 years of investing, really, Canada has been a tough place to invest. I put up a visual that at the end of 2024, the 15 years prior, the S&P 500 was up something like 425% and the TSX up 100%. Like that's a massive difference to be 12% per year versus 5%. And the reasons for that were, I think we're all pretty aware of them, high tax burden, interprovincial trade barriers, a regulatory environment, we couldn't get anything built. And also we had a secular bear market in commodities. So all of that led to very little economic growth, very little business investment. But I was saying all that and it sounded pretty bleak, but it also means you're starting from an extremely low base. And so expectations are low, but we do think the cycle's kind of breaking. And really the reason for that would be government initiatives. I think maybe they're starting to see what's happening and they're making commitments to speed up regulatory reviews, breaking down interprovincial barriers, a general willingness to work with the private sector. So that's interesting. Defense spending. Canada is spending more. They have to now. President Trump basically was the catalyst for that. And so I think not just in defense spending, when you have these big expenditures, they can create other industries. Having to spend this extra money can help in different ways. It's not just buying, tanks and different things. It's doing it smartly and in different ways, and having the government behind you to help develop these areas is going to be very important. And then critical minerals I spoke a lot about because if we are in this regime change going forward, one of the biggest things that is going to be important is these critical minerals that are a lot in the news now. And the reason for it is China's basically spent the last 20 to 30 years dominating refining of these critical material and minerals. And so it's not as though we don't have the resources themselves. It's that China's done it cheaply. They've done it so easily. They've really gone into it, whether it's refining the rare earths everyone talks about, but it's everything. It's copper. It's things that are needed for the electrification, for defense spending. And so I think this is just really unacceptable to the West, because I brought up a line that said 78% of US military weapon systems, the supply chain has exposure to China for critical minerals. And so how can you have one of your biggest adversaries have a choke point on that? So I think it's been pretty clear that we need to see that being changed. And Canada has an abundance of critical minerals. So I think there's a real opportunity there. So as Canada sits here, there's great opportunity. Can we take a hold of it? I think the one thing that we have really been saying to everybody is we were skeptical, because you read headlines, you read stuff, people are saying all the right things, but the companies that we talk to, which we generally put more stock in than any newspaper headline, because headlines are just that, right? They're all over the place. You never know what's being written and why. But the companies we talk to, and we've met with probably hundreds of companies so far this year, and it's a huge change from years past. They're saying things are different. They're saying the government is supporting them. They're getting things done. Regulatory reviews are taking less time. And all of that meaning they're willing to invest now. So we've been very pleased to hear a lot of what we heard kind of in the last 6 to 9 months. And so I think that's even more important as a takeaway for where Canada is. So you say, what does it mean for Canada? I'm pretty optimistic, which is a huge change from where I've been in years past.
Yeah, and I understand why. I think the shift in behavior, hearing from management teams that conditions are improving, would change your behavior. And I agree with you. I think it feels like the opportunities in Canada are really a reflection of these growth enhancing policies that seem to be coming from Ottawa. So again, I can see why. We've talked a lot about equities, and there's, so much we can get into here. And we talked about all of these themes at our mid-year event. But fixed income also seemed to react to the normalization of energy prices after the de-escalation in the Strait of Hormuz. Can you talk about that and what that means to our thinking around credit and fixed income?
Yeah, so when you say it reacted to energy, I think what you're saying there is interest rates rose.
Yeah.
And so expectations as well for either cuts from central banks, whether it be in Canada, the US. And I think it all falls around that statement of the regime change, right? And the thing being, inflation fears are real. And the way that inflation kind of embeds itself in fixed income is higher interest rates. And when I say higher interest rates, it's probably more normal interest rates if we were to take out the 2010s, that decade. Prior to that, US 10-year yield at 4% wasn't crazy. But considering we had years of 0% interest rate policy, this is a change. But I think what we're saying is these shocks will probably continue. We're going to get shocks like this, but also the memory of these inflation scares means we don't believe we are going back to a 0% policy anytime soon. And what it means for our fixed income holdings and bonds is that we think it's a real asset class again. And when I say that, it was hard to invest in bonds for a long time just because you were getting very little return. And with the risk of, if rates did rise, you could get wiped out. And that was basically what happened in 2022 when interest rates went from 0 to 5%. A lot of bonds down 20, 30% over that time period. And so now what we're saying is, risk-free rate in the US, call it around that 4% level. Canada here, it's a little bit lower, but we think it's an important part of asset allocation within your portfolio. And we continue to look for bonds, whether it be in the investment grade space or high yield or different areas. But it's a nice ballast to a portfolio where equities can compound over time, they reinvest, but you also now get that interest income as well. So we believe it's going to be a real asset class again.
Yeah. And as you said, energy prices, and that's what I was referring to, obviously relate to inflation. And so do labor markets. So anything that you're watching as we head into the second half around labor?
I mean, we're always watching that because we do think that's the number one indicator for any weakness in the economy. Right now, everything that we've seen, I mean, we had the US jobs print yesterday that was weaker than anticipated, but I think there's a few things there. The prior 2 months were stronger than expected. So if you kind of normalize those things, I think the labor market's in a decent spot right now. Something I've been talking a little bit more about on those, everyone watches the non-farm payrolls every month, and it used to be we'd want to see 250,000 jobs, and that would, be your steady state, good economic growth. But again, the U.S. has changed with population growth and immigration changing and all that. And there's a lot of good, smarter economists than me at this, but more and more people are talking about you kind of only need maybe 50,000 jobs to be made every month to continue at a steady state. So that is one thing that we've noticed. You don't necessarily need those massive payroll numbers to continue growing. I think it's shown, we haven't been averaging 200, 250 by any means over the last couple of years, yet weekly jobless claims continue to be at near all-time lows. And I think that just shows you that currently the labor market is healthy and strong, but it's definitely the number one indicator that we watch, because we always say that's when you really make lifestyle decisions, is if you lose your job, that's when the changes really get made. But if you're getting paid, you have a job, generally speaking, the economy is doing well.
I feel like we've covered off a lot of the themes that we discussed at the event. Is there anything else that you think our listeners might be interested in before we wrap up here?
I guess I've even gotten some questions saying like, what's happening with the war? Is it over? How are we just looking past all of these issues? And I think my answer to it would be the market's telling you that the war is over, and that's probably the right read. It's not over on a negotiating standpoint, but generally speaking, and you're always going to have disagreements, and for maybe months, could be years, but that's kind of the nature of the region. Unfortunately, it's a complicated situation. But I think what the market is saying is that the tail risk has really come down meaningfully, right? So the like a full-on escalated war for months and years, I think that is looking to be behind us. And so from a market perspective, I think that's important, but it's not necessarily that we won't continue to hear it in the news. Anything else, I'd say cautiously optimistic just on that broadening out theme that I spoke about earlier. And I think it really did get a bit of a pause earlier this year. But if you're able to see and we're seeing it, ISM manufacturing, PMIs, kind of real economic growth. We haven't been in that environment in a long period of time. A lot of the market's been driven by technology, Magnificent Seven, AI. If we can get just a normal economic recovery, I think it's going to be a very healthy situation for the market and for a lot of the companies that we look at and own and invest in. So those would probably just be the few things that I leave in some of the questions that I hear a lot.
Yeah, I think I'm glad you went back and visited the Strait of Hormuz, because I do get those questions as well from clients just asking. It's been a de-escalation of the situation, but there's still not the same amount of ships or tankers getting through. So what will that mean? So thanks for bringing that up. I think it's important. So it sounds like base case is economic growth, but cautiously optimistic in the sense that there's all these variables on the horizon. And so continue to stay diversified and disciplined in terms of best-in-class businesses. Is that a good way to sum this up?
Yeah, I think that's a great way. And it's very difficult to predict economic environments. So really our investing philosophy kind of always maintains the same. Absent some of these regime changes, I think it's important that we've touched on today, and that's more of a longer term mindset that we're looking at. And so that means we're looking at different secular trends going forward, but it's all rooted in the same philosophy. We want to own best of breed businesses no matter what sector or theme we're in, and that's going to continue.
Thank you, Andrew. As always, thank you for your perspective. Our clients really value your insight and your ability to bring clarity to complicated markets. And thank you to everyone who's listening. If today's conversation raised any questions for you about your portfolio or wealth plan, please feel free to reach out to us at any time. We always love hearing from you. We look forward to speaking to you again in September. Enjoy this hot weather and stay well.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.